So what I want to talk about today is commissions with whole life insurance products, how they work, and really if your goal is to maximize the cash value on a life insurance policy, how will commissions impact that policy? And what I'll start with is when you are taking out a whole life insurance policy, if your goal is maximum cash value, let's pretend you could cut the agent out altogether and just work directly with the insurance company. What you would find is if you called up the insurance company, they designed that policy exactly how you wanted, they sent it to you, or you decided to work with a life insurance agent and the agent designed the policy in the same manner, the policy performance would actually be identical for you. The difference is that the insurance company would pay the agent a commission because the agent has now brought that insurance company business that they otherwise would not have had. So the reason I begin with that is when a policy is set up correctly, or I should say regardless of the design, commissions are factored in to life insurance policies. But when it comes to the design of the policy, commissions are paid depending on where your money is going, which can be complex in itself. Like, what do you mean where my money is going? Well, you can choose how much of your money goes toward insurance premium, which you'll see will generate the bulk of the compensation for an agent, or money can be directed toward riders. Mainly a PUA stands for paid up additions rider, which will maximize your cash value. You'll see it immediately, and this pays a much, much lesser commission than what base premium dollars do. And then you've got the insurance company selection, the product selection, all of which have an impact on cash value performance and on commissions. Now, as we get into all of the detail, I'm going to go through specific details on different products, companies, so you can have full transparency there, but also what the industry is trained on, what you should look out for as a consumer. As we go through all of that, generally speaking, what you will see almost every single time is the higher the cash value, the lower the agent commission will be, particularly upfront. Now, commissions tend to last 10 years with most life insurance carriers. I've got a heavy upfront commission, and then there are renewal commissions. There's a lot to it, which we'll get into detail on. But generally speaking, the more cash value you have upfront, the less the agent commission will be. So let's get on into it. When it comes to whole life insurance products, when cash value is the goal, which is primarily who we work with, individuals and companies that are primarily focused on maximizing the cash value of a life insurance policy. What are the core benefits? Well, the cash value is a safe, liquid, and tax-free area to position money. Tax-free if we don't trigger a MEC or another taxable event. But this is the why as to why people are attracted to the product. Who uses it for the cash value? Well, you have corporations. When you look at executive benefit planning, corporations have used for a very long time whole life insurance policies designed for high cash value, and they continue to do so. Wealthy individuals do so. And then how about the average individual? Well, yes, if they ask the right questions or if the agent they are working with them is willing to show them those options. And I'm going to get into exactly what that means as well. But have you ever felt like this? Why do some people, like wealthy individuals or corporations, seem to get special treatment? Why are they always shown these attractive policies, whereas everyone else, the average individual, is not? And some wealthy individuals are shown basic whole life insurance policies and they immediately look at it and say, this is junk, I'm not doing this. Like, there's no way I'm putting my money into this product. And then you get the sales tactic, oh, by the way, there's this option. Oh, okay, I will do that. Like, how come everybody does not get that, oh, by the way, here's the other option that really maximizes your cash value up front? Have you ever felt like that? Like you're not being shown something by the company or agent that you're working with? Because some people love their whole life insurance product. They see money up front, they can access it, the internal rate of return, the growth rate is maximized, while others are almost outright ripped off. They are taking huge hits, and what's happening on the flip side is that agents are receiving very, very high commissions. And as an agent myself, I'll state this, I have no issues with agents getting paid because it can be a tough career being in the financial services business. But where I do have an issue is if you, a potential consumer or policyholder, expresses, I am interested in the cash value, and I want the maximum cash value possible from start to finish. Like, cash value is why I'm doing this. And you ask me the question, is this policy set up for maximum cash value? And I tell you, or I imply, because I don't want to lie in my own mind, if I tell you or imply, yes, that's set up for maximum cash value, or say something like, as far as I know, it's set up for maximum cash value, and then you find out after the fact a better option existed, and that better option existed at a lower commission to me, that's where problems pop up. That's where people feel taken advantage of. And that's the kind of stuff that, unfortunately, we have to ask a lot of questions or hire third-party advisors to vet and interview insurance agents in order to make sure we're truly getting the best deal. And a lot of people just throw their hands up and say, forget it, like, I'm not even going to deal with this, which I fully understand. So hopefully this video helps to teach you what questions to ask and more transparency around exactly how commissions work as well. So agents who are selling you the product need two things, or two qualities, in my opinion. The first one is the agent needs to know how to set up the policy for high cash value. I'm specifically referring to their knowledge base. They A, need to know how to work the software, or B, need to understand the software, how policies are designed, what are the insurance carrier's premium and PUA limits, how do I MEC test a policy, not just based on what the software shows me, but with conservative dividends, guarantees, there's a lot to it. Do they have the proper knowledge base? That's number one. Do they know how to set a policy up with a minimum premium for maximum cash value? And number two, they need to be willing to set policies up for high cash value. So what do I mean when I say willing? Well, what I mean is the commission. They need to be willing to set up a policy where you're paying in the same dollar amount, so you know the dollar amount you're going to pay into a policy, and they need to be willing to put less of that money toward the insurance premium, which will reduce their commission. And I state it in that manner that they need to be willing to do so because just in the years of being in this business through experience, some have stated that they don't want to design policies in a certain way because it pays a lesser commission. Or they don't want to use certain companies because they pay lesser commissions than other life insurance companies. So this stuff does exist, and I understand it from all aspects, but we need to be aware of this. So what I'll add here is that life insurance agents are not incentivized to sell you a high cash value life insurance policy. They are, or I should say we are, incentivized to sell you a policy that has less cash value up front because it pays me a higher commission. So this is what you're up against when you're looking for a high cash value policy, if that's your objective. So how do you find the right person here? Well, number one, is the agent you are working with knowledgeable? That's the first piece there, meaning will they share the knowledge that they have with you or use it to their own advantage? Very important here. Are they very open? Can you ask questions? What I'll also add in here is, are they approachable? Do you feel like you can ask them questions all the time? Or do you feel like you're annoying them? They get defensive. This kind of stuff goes on in all industries, in my opinion. But if you feel like you can approach the person, or if they're just an open book, maybe they have resources available you can just look at. A lot of people have appreciated this over the years because they build that trust factor. Which leads into the second question here. Do you trust them? Speaking personally, whenever I partner with someone, or if we're going to be affiliated with someone, or if I'm going to refer people to another agency or firm, perhaps that I don't even have a financial relationship with, I need to, one, understand that they know what they're doing, but two, I have to have full trust for them. That's the most important thing when I am qualifying people that we are going to work with, our company is going to work with, because it's important. If I'm going to refer you to someone that we're working with, if you're working with us already, if I'm going to refer you to someone else or make a recommendation, I need to have qualified that person first, gone through their process personally, and I have to fully trust them. Because if I don't, and then something goes wrong down the road, it's like, I made that introduction. It's like, no, I don't want to do that. So point is, the person has to know what they're doing, and we also have to trust them. So let's provide a quick example on this. So with whole life insurance policies, we can design them. What I mean when I say design them is we can actually choose where our money is going. So let's assume for this example, you're taking out a policy and you're paying in a total of $10,000 per year. Well, you can choose where that money goes, and there are two primary areas. You can direct it toward the base premium, or toward a PUA, which stands for paid up additions rider. Premium dollars with respect to your cash value. So first I'm going to go through how to maximize the cash value. Premium dollars with most traditional whole life insurance products do not build any cash value in the first year and sometimes in the first and second year. I'm going to pull up an example where you'll see it not show up in cash value in the first year. The reason why is because that primarily purchases one a death benefit up front. Whereas PUA dollars, you see show up in cash value right out of the gates. Typically, whatever your PUA payment is, depends on the company and product, you're going to see between 90 and 95% of that PUA payment immediately show up in cash value. This is money you can access, begins compounding. This is the key to accelerating the cash value growth on a policy. So on the topic of commissions, if zero shows up in cash value, in your cash value, based on dollars that go toward premiums, what do you think that pays in terms of commission? Well, let's look at an actual example here, and this will be fun. So what we've got up here is a traditional old school whole life insurance policy, $10,000 per year being paid into the policy. Where is the money going? We see up here at the top, all base premium. So all base premium, meaning no PUA riders attached, $10,000 is paid in. In the first year, this is your actual cash value, $336. Often people see these types of products and say, why would I do this? Like, I feel like I just dumped 10 grand down the drain. Unless I die, then there's almost a $500,000 death benefit. But at age 40, I can get a term policy for $500 per year, maybe even a little bit less than that for $500,000. Next year, I pay in $10,000. I see that premium now start to come back to work for me. So it's building cash value. But as I look at the payments here, so you paid in 10 grand per year for 10 years, that's $100,000. And when do you have $100,000? Year 12. So it takes 12 years just to get your money back, let alone see any type of gain on the cash value. And this is often when people hear about high cash value policies being safe, liquid, tax-free, net growth rate, the internal rate of return falling between 3 to 5%. This isn't it. This is a traditional whole life insurance policy. What does it pay though? Because the topic of this video is on commissions. Well, here we go. So this is a policy more of a traditional type where the first year, the commission rate on the base premium is 85%. 85% of $10,000 is $8,500. So we've got the annual commission, and then we've got the total commission. The total commission will tally up all years. So first year, $8,500. Second year, I pay the same $10,000 base premium. The renewal commission on base premium dollars is 10% with this particular product. Years 2 through 4. So it's $1,000 per year. And then $300 per year through the 10th year. So the total commission I earned, call it my lifetime value of this sale, is $13,300 in total commission that I, the agent, would receive. Now what's interesting is we can design the policy a bit differently. So here's the exact same life insurance product, but we're going to design it in a manner where 50% of your payment is directed toward the premium, and the other 50% is directed toward that PUA rider. So exact same insurance product, exact same insurance company, exact same out-of-pocket to you, $10,000. What do you immediately notice here? Look at your cash value. $4,800 right out of the gates, compared to this one, $300 and change. Now there is less death benefit up here. A big reason why is because the premium is the #1 driver of the death benefit, or I should say a primary driver of the death benefit. But as I look at the cash value difference here, what do you notice? Well, by year 8 now, you've paid in a total of $80,000 and you have $80,000. Compared to the example on the left, you had $69,000 at the same point in time. So what's fascinating about this is you paying in the exact same dollar amount for the same period of time, and you've got greater value with this policy simply by the agent knowing how, going back to the knowledge base, knowing how to design the policy properly. Now, the compensation. Are they willing to do this? There you go. First year, just about cut in half. There are commissions on PUA payments. So we've got $5,000 toward the base premium. The other $5,000 is directed toward the PUA rider in this example. But here we go. First year, total of 10. Total annual commission, $4,400 and change. Through the fourth year, there's your renewal commissions, and then $300 and change through the 10th year. How this one's a little bit more is because of the PUA commissions. So there are PUA commissions. In this example, the PUA commission rate each year is 3.25%. But as we look at this, there's the commission difference. The biggest hit is upfront. I see it literally cut in half, but then over 10 years, it's about a $5,000 difference there. And this is based on an annual payment of $10,000. Let's max this thing out. When I say max it out for the consumer, you the policyholder. So now what do you notice? Look at year one. You're paying you're paying $10,000. Where's the money going? Here's your premium, $1,000. Now you, the policyholder, have $8,200 up front. We attached a term insurance rider to this policy as well. We did this mainly to prevent a MEC from occurring, but the total death benefit is at $320,000. And you'll notice it remains at $320,000 while we are funding it. But what do you notice here at the cash value? Break-even point is now between years 5 and 6. Instead of year 8 in the last example or year 12 in the first example. And here's the big thing. Same product, same individual, same health rating, same out-of-pocket. So if you're working with us, we're designing the policy, you're saying, okay, let's pull different levers to try and maximize the cash value here. What you'll see happen, the lower we drive that premium, guess what happens? The higher that cash value is driven as a result. By year 10, you're at 117 here. The last example, you were at 107, and the first example, you're at 92. If we look at year 20, or let's just look at year 21 when he's 60 years old, first example, 166. Second example, 193. This is our 10% premium, 1090 design, $212,000. All we're doing is redirecting where the money's going. This usually does it for most people. Where they say, okay, this one gives me the most cash value and flexibility because I'm only committed to this. But when we look at the commission, going back to the willing piece again, guess what we see? Look at the first year, a little over $1,100. And this is still the same 85% commission on the base premium. This is maxed out. This is what we actually receive from this life insurance company. The total rates at the highest rate that they pay us, $10,000 in, $1,143 in the first year. Over 10 years, if we just tally up the total, so here's your annual, 1, 2, 3, 4, 5, 6, all the way down to 10. Over 10 years, $4,200. What's interesting about this? Well, look at this. If you go with this design, the agent, over 10 years, will make less than what he would make in the first year with the 50-50 design. So a 50% base premium and then 50% PUA rider is the middle example. So if a policy is designed for maximum cash value, what you will see is a lower compensation. And when you think about it from the insurance carrier's perspective, base premium dollars don't show up in cash value in the first year. So they've got more money to work with and pay the agent. If we're putting more money into PUAs, that's money that if the policyholder wants to cash out or access their money, they can do it. So they're not going to have as much money left over to pay agent commissions. Let's continue on. So if your goal is to take out a high cash value life insurance policy, here are some questions that I would ask. I hope this helps. So looking at everything here, number one, does the company have proof of performance? So when it comes to whole life insurance, you think buyer's remorse exists? Yeah, it does. And it has for a long time. That's why if you were to Google search or go on YouTube about whole life insurance, you'll see some material that speaks very positively about it, but the majority of material you research or you find will speak very, very negatively about it. And you could probably find 100 stories about people who had taken out whole life insurance policies and felt like they were scammed or felt like they were ripped off. I thought I was going to have $1 million and it ended up just having a negative return all the way through. Like, it's not a good idea. This happens so much. So where buyer's remorse comes into play, what I've experienced a lot, is where someone will take out a policy. They're sold really based on the illustration. Here's the projected cash values over time. And then the actual values under-deliver significantly compared to what was projected on that illustration. So I tell you, you're going to have $100, and then at the end of the day, you only have $70. What are you going to say? What's up, Steve? Like, where's the other $30? Well, based on our guarantees, we had some other back-end expenses. You don't have it. So what I'm very big on is doing what these guys do, actually, corporations, which is asking for proof of performance and using companies that have a track record of actually disclosing proof of performance, meaning not a projection, but real policies that have lived the test of time, produced strong actual internal rates of return, call it 4% or greater. That's the big question we'll always ask insurance carriers, just because what goes on due to a lack of proof of performance, people get into products, it underdelivers, they get upset, and they don't have a good taste in their mouth regarding whole life insurance. So to avoid that, I would ask if the company, the insurance company, has proof of performance, not dividend history, a real policy that is more than 10 years old. What is the actual internal rate of return? The net growth rate, not dividend history, not projections. Very important to ask that. Next question. Can the policy be set up for higher cash value? So, for example, once you get the actual design from the agent, so those 3 examples we just looked at, let's assume that I send you the example, that 1090 split with the high cash value policy. Ask this question. Can the policy be set up for higher cash value? Point blank, because if you ask that question, I should say yes or no. What if I said something like this? You ask me, can the policy be set up for higher cash value? Upfront, long-term, can it be improved, Steve? That is my question to you. And I said, as far as I know, it's set up for maximum cash value. How much confidence do you have in that answer? As far as I know. Like, no, give me a yes or no. I'll tell you a story about that. Years ago, I was working with a woman who's got a policy with us now. She was about to sign off with a local agent for a high cash value life insurance policy. She had a relationship with him, knew him for a long time, and she asked him the question, is this policy set up for maximum cash value? This agent has a lot of experience. His reply was, as far as I know, yes. She sent the policy. It was not set up for maximum cash value. We provided examples with that exact same product, same company, same health rating, same everything. She had significantly more value upfront and long-term, more flexibility. She's bounced her payments up and down. The difference was, guess what? The compensation there. Like, that's the kind of stuff that goes on. So this is a good question to ask, in my opinion. If you were my cousin or my brother or sister working with an agent and I wasn't in the business, or you preferred not to work with family and said, hey, what should I ask? I would ask them that question, right? Because we all have a good sense of reading people. So if someone tells us yes or no, they're really committing themselves. Like, I can't tell you yes and then have you go find a better option. And again, going back to the proof of performance, you will see a lot of life insurance companies project greater values than each other, and that's all based on illustrations. Proof of performance is the big thing here. Number 3, can you provide a commission disclosure? So you don't have to ask this question, but if you want to, it's a perfectly valid question. And if someone resists you on that, that's usually an indicator that they've got something to hide. In my opinion, it is. Like, why not? Just provide a commission disclosure. The issue is, if someone discloses their commission and you share that with someone who has experience to say, hey, here's the illustration, the cash value projection, here's the commission, is this maximized for my benefit? Meaning, is it maximized for my cash value? So you sent it to us. And then we said, okay, can actually reduce the commission, and here's the same product with the same company, improved cash value. That's what creates that, oh man, like, why did this person show me this option, or what's going on here? We grow suspicious. So This is a good question to ask, and if someone does not have anything to hide, they're going to show you this info. Now, what I'll add is when you ask these questions, emotions and scare tactics are often used to somewhat distract from the questions or not answer them. A specific example, and this is very, very specific, can be around this topic, OYT, which stands for 1-year term insurance rider. These are frequently used by corporations because it's a great method to maximize the cash value and flexibility of a life insurance policy. However, when you look at them, when you attach this rider, it pays a lower commission than a different type of term rider, a level term rider that can be attached to a policy. In addition to that, it does have a couple moving parts, so it can be a little bit complex if we dig into it, which we've got content that goes through it. But my point is, often we'll see tactics used to try and scare people away from this because it could harm them. The policy might blow up down the road or something like that if we attach this rider to a whole life insurance policy. Well, this rider allows me really to juice the cash value. Think of it this way. If I want to attach a supercharger to my car, I'm going to be able to move faster. However, I might have to change the oil more frequently. So someone can use a sales tactic who is against superchargers, say, well, if you attach that supercharger, the thing might blow up. Oh, I've got all these horror stories. You got to make sure you change the oil so often to maintain it. I'm like, all right, well, my mechanic regularly changes my oil. He or she maintains the car all the time. Like I'm good. And I've seen people have the highest level of success with this mechanic or with this supercharger on their car. It's like it can be set up very, very easily, but instead of going through the details and being transparent, we see these emotional scare tactics used to try and sell a higher base premium design, which generates a higher commission. They're usually long-winded examples too. So, last question to ask, and this isn't really a question, more of a comparison. If you're comparing illustrations, always ask for the guaranteed values. The guaranteed values are fantastic to look at. One, it gives you just transparency on what the worst case scenario is, which is great. But then two, when you're looking at the guaranteed values, you'll really see product design. A lower base premium will always generate higher cash value. Sometimes we hear some other things, which I'm going to get into in a minute. But my point here is looking at the guaranteed values will provide total transparency around that product design and if it's set up for maximum cash value. And you can also mech test it as well based on the guarantees, which is great, making sure we don't trigger a taxable event. And with all of this, like it's your money. So never feel like you can't ask these questions. I know sometimes it can be sensitive or you might feel nervous in asking these questions. It is your money going into a policy. Much better to ask the questions up front and make sure everything's done properly, because where people have regret is when these questions are not asked because they don't know to ask them. Then afterwards, they find out it could have been set up differently if only they would have asked the right questions or someone would have done it for them or if the agent would have just done things properly from the get-go. So here's some more information that you might find valuable. And in the next couple of videos, we're going to get into some very specific details. So, commissions, rates. The actual commission rate that is paid to agents will vary depending on the insurance company and the product. Now, what I have seen to be consistent is companies that have delivered the highest cash values on actual policies, not just illustrations, but actual policies, have paid the lowest commissions. And here's what you'll typically always see. The higher the guaranteed cash value is, the lower the agent commission is. Here's the thing I would avoid. If you ever hear this, you will have more cash value long-term if you go with a higher base premium. A higher base premium, if we go back to that chart, what does that result in? Less cash value, especially up front. Some agents will say that if you go with a higher base premium, you'll have more money long-term, and the reason why is because the base premium is the main driver of the dividend. Here's my big thing with that. You will see that with some companies and products on the non-guaranteed side of an illustration, but the issue with it is when I look at actual performance, I've never seen this validated, not once. And often we'll hear this from people who have been in the industry for a long period of time, call it 30 years. So my question would be, if someone's been in the industry for 30 years and they claim that the base premium, so the higher base premium, which sacrifices your cash value up front, will drive that dividend north, which will give you more money long term, what it will give them is more commission. But over 30 years, or if they've been in the business for a long time, do they have any proof? Because we have not received a high base premium policy delivering a strong internal rate of return on cash value. So how I view it is, what I'm doing, if I say go with a higher base premium, because if dividends go up, you should have more money long term, is I'm guaranteeing myself a higher commission by telling you to do that, going with the higher base premium. And I'm hoping that one, dividends will go up, and if they do go up, that my cash value will follow, the base premium will actually drive the dividend north, and you will have more money in cash value as the consumer. The thing is, throughout history, even in high dividend interest rate environments, we've seen this illustrated, but we have not seen it actually happen. We actually have a video on that we've got up top you can click on that goes through a policy that was about 15 years old. And we pulled what was actually illustrated via dividends. It was an all base premium policy. We got to see what was illustrated and then what actually happened. And it shows the things that go on behind the scenes as far as how insurance companies adjust how they actually apply a dividend to a whole life insurance policy. In summary, we've seen minimum base premium policies deliver stronger cash value, and it is what these guys do as well when we look at corporations and the wealthy. So a lot of info here. What we are going to progress into in the next couple of videos are specific examples with different companies, different products. We're going to go through how commissions work with the rates and such. Hope you enjoyed this video. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.